Good morning, folks. Welcome to the weekly general update for the 6th of August. And as everybody knows, we've had a pretty tumultuous week, and particularly the last 2 days. And I've communicated a great deal about that over the last 48 hours, so I'm not going to repeat too much of that because it's all in written format. But I really want to focus on the charts and the bigger picture, and particularly the strategy of how we move forward from here. So just a reminder, this is general advice only. You need to make up your own mind as to whether you follow this advice directly or the level of exposure that you have. So the action for the week as a summary, for the week as a whole, the S&P closed down 7.2% for the week, which was certainly one of the worst weeks we've seen since probably 2009, 2008. Late on Friday afternoon, in fact after the US market closed, Standard & Poor's downgraded the US AAA credit rating to AA, and that's a bit of a wild card. There were rumours during the day about the fact that that had happened, and that is what was partly behind the fall in the US index during the day before it recovered. The fact that it did recover indicates that maybe this is already priced in some way into the US market, because they've been talking about this for quite a few months now, and it really stems directly from just the rank stupidity in Washington between the two political parties. That's really what's led to that. So it's a bit of a wild card. We don't really know how markets are going to respond to that, and I think it's probably going to be an evolving situation. It's certainly not helpful, this step. The ratings agency, Standard & Poor's, downgrading, but I would say that ratings agencies now have lost a level of credibility since 2008 and are probably not as closely followed and watched as they once used to be. Turning to the ASX 200, we closed down 7.4% for the week, so pretty much the same as the S&P. Gold finished 2% higher, and it will be fairly volatile because we've got a couple of competing forces. One, the major force, will be the fact that people are getting very, very nervous about paper currencies and the whole direction of where the world is headed with respect to debt. So I believe that there is a very strong underlying upward trend for gold and silver. Opposing that is just the liquidity issue. Traders that are perhaps got margin calls in the stock market or currency markets are being forced to sell whatever they can to cover those margin calls, and even though they'd probably like to hang on to their gold and silver, they're forced to sell it just to raise cash. So that's more of a short-term impact, and that one will pass fairly quickly. The bigger trend is definitely up, but it does mean that the price will be volatile in the short term. Silver was lower on the week, which you might think was a little strange. It didn't go with gold, but look, silver's pretty volatile anyway, and 3% down in a week is not really that much, and pretty much all that loss in silver occurred in the last couple of hours of trading on Friday, so we could pretty quickly see silver bounce back. And I'm really looking to buy the dips when we get to the charts to maybe around the 36.80 level. Copper was down nearly 7% on the week. It had been holding up really, really well, but basically fell apart on Friday, which is to be expected, I guess. So just from a strategy point of view, market sentiment, which was positive, markets had been tracking American corporate profits, which are good and still are. And I'm not sure that these events are going to change that dramatically in the short term, because American companies really are doing quite well. But sentiment has now shifted very, very abruptly. It's gone very negative, and it's now focused very much on what's happening in Europe and what's happening in the US. with their economy and with the stupid politicians. So we should now maintain we should have a fairly minimal trading exposure to the long side. We've been down to for members, one long and one short on the large caps, and that was prior to Thursday and Friday. So you shouldn't have experienced any pain whatsoever there. On the small cap side, of course, we had some relatively minimal exposure, and we've still got several trades in profit despite what happened on Thursday and Friday. So from my perspective, you really should be in pretty good shape. You should have minimal exposure, and you really shouldn't have suffered too much damage. From here, short selling is obviously going to be far more productive, but it's a matter of how we actually gain entry into those short positions. But there's certainly some good profits to be made, and that's one of the things about volatility. It can be a bit scary, but if you're positioned effectively, you can make some wonderful profits very, very quickly. So I really urge you, if you're trading in the market, not to be fearful of what's going on, but to embrace it as just a rare opportunity that we don't get all that often. We need to be prepared to buy when there's panic sell-offs, and we can make some pretty quick profits on the turnaround. So volatility is a real bonus, I believe. It scares people significantly sometimes, but it's a real bonus. You just need to be positioned well, you need to be quick, and you need to be decisive in what you're doing. And that's certainly my role, is to keep funneling that information through to you. And precious metals will present great buying opportunities. It's probably not right at this very minute, but there are some great buying opportunities coming up in precious metals. Excuse me. So let's have a look at the charts. So we'll start first of all with, let's have a look at the US dollar index initially. So you can see basically the US dollar index, despite all the volatility, has really gone nowhere in the last few weeks. We had a big rise on Thursday night with the fears about what was going on in Europe. It went a little bit higher on Friday, but then lost all those gains again, and I guess that's related to the downgrading of America's credit rating. So there's not a lot that we can determine there. Let's have a look at the S&P 500. So first of all, on a monthly chart. Now let's keep this in perspective. Yes, there are certainly some issues out there, and we've had a pretty severe down day, but the amount of the correction so far in the last 3 or 4 months is only of the same dimension that we saw in 2010, which was just a correction in the ongoing uptrend. Now, I'm not suggesting that the American market is now going to go back into uptrend, because I don't think it is. I think sentiment has now changed quite abruptly, which is not what happened in 2010. So I'm not saying that that we're going to just continue back up as we were before and everything will be fine. I guess anything's a remote possibility, and if the European Central Bank did step up and announce some massive money printing, as Ben Bernanke did last year, then I guess anything is possible, but it's a bit unlikely that we're going to see a resumption of the uptrend. I think we're going to see a broad trading range somewhere between perhaps 1150 and maybe 1260. So let me just put some marks on the chart. I think this could be the trading range we might see for a while, but equally it's possible we could see lower prices yet. So let's swing over to a daily chart and have a look at where those price points might be. So initially, you can see, let's just summarise the last week. We had a bit of a sell-off on Tuesday night. That followed through on Wednesday night. The market went down to exactly this 38.2% retracement. Let me just pan back. So this retracement I'm taking from the bottom of the correction in July of last year to the top. So that's the most recent run up in the market. So 1233 was the line in the sand. The market got down to 1234, so within 1 point, and then abruptly turned around and finished quite strongly. And that looked like a reasonable reversal candle. However, all that got lost abruptly on Thursday night, and that was largely due to events in Europe. Now, swing into Friday, and we had an initial move upwards in the market when the jobs report came through. The jobs data was pretty awful. In the last 4 months, the monthly jobs figures have dropped from around 250,000 down to about 117, but it was better than what was expected. So initially the market cheered and the stock futures went up. Then the rumours of the credit downgrade came, and that belted the stock market all the way down to 1170, which is, so we broke through the 50% retracement level, but we're looking at 1148 as the next support. So the market stopped mid-range. It is massively oversold. Let's just pan back and see how often we've seen the RSI down at this level. And we've got to go back to even in March of 2009 at the end of the crash, the RSI was not this oversold. We have to go back to October 2008, which was right in the middle of the crash. That was when Lehman Brothers failed and it looked like the sky was falling in. So that's the last time that the RSI has been this oversold on the S&P. So a rebound is extremely probable from here, despite what you might think by reading the news reports. Now, the market then recovered from those lows of Friday and finished around about flat. So it's a sort of a reversal candle, but not one that I'd hang the hat on for two reasons. One, it didn't finish near its highs, and two, it hasn't really reversed off a fairly obvious support level. So to me, it's a question mark. I wouldn't rate Friday night as a reversal pattern, certainly not one that we want to trade. So that means in the short term we need to be cautious. Let's have a look at gold and silver. So gold, we hit a high of 1681 on Thursday. Had a bit of a reversal from there on the session, and you can see gold extremely overbought, so a correction is really on the cards. But it did hold up pretty well on Friday night. Now, what I'd dearly love to see is a retracement in gold back to the 1603 level, or somewhere around about that level. And until we get it, I think buying gold at this level, even though it may go higher, is just a bit too dangerous. So really looking for an entry around about the 1603, perhaps 1610 area for gold. I think that's a much better position to be entering. Let's have a look at silver. And silver did pull back a bit on Thursday and Friday, as you can see, and really looking to pick it up perhaps around about this 61.8% level. You can't really see that too clearly, but it's around about just under $37 would be a better entry point. Now you can see silver is not as oversold as gold is, so I think we're closer to a buy point on silver. Now let's have a look at the ASX 200 on a monthly chart. So you can see here we closed below the lows of May and July of 2010. So we are now, I believe, heading lower. I think the probability of this market heading lower is now extremely high. So that's on a monthly chart. Let's look at it on a daily. You can see we had fairly decent negative down days on Wednesday and to a degree Thursday, but Friday really kind of took the cake. Now again, we're extremely oversold on the RSI on the Australian market. Let's pan back and look at the last few times that it's got this oversold. So I'll just pan back. It's done it more often than the US market has. So back here we had a very negative time, which was January of 2008. The market did bounce and bounced quite strongly. It was up probably nearly 800 points off its lows. So it eventually did roll over as we went down into the GFC, but we did get a very strong bounce. The next time we were down there was a little bit of a bounce, came about a week later. The next time we were this oversold, we got a bit of a bounce of about a couple of hundred points. Just tightening here a little further. So then the next time we were down this oversold was the 15th of March this year, and we just then had a stunning rise of nearly 500 points from that point. So we're now down at a level where historically we've seen some very significant bounces in the market, even if it was only short term. So that's why I don't want to go stampeding into a whole lot of short positions at the moment. I would rather position ourselves to do some of that on the bounce. So that's the ASX 200. Looking for levels, we've got a level down here at 4053, and the next level would be about 3820. So we've broken through the first level, and we're not very far off. We're only about 30 points off the second level, and 3820 is a distinct possibility. So that's it on the ASX 200. Let's have a look at it on the finance index, which has been hit pretty hard. It's down now to this important support level down here, which is picking up these peaks from April of 09, June of 09, and again in June of 09. We've broken through this second level, so I really think there's a strong possibility that the finance index is going to head down to this 3,500 level. So some more downside likely on the finance index, but we may see a bit of a bounce first. Now materials. That's materials on a weekly chart. Let's look at it on a daily chart. You can see also heavy selling on Friday and on some big volume, but also oversold. Now let's look at the Small Ordinaries Index, which really up until Friday had been holding up pretty well. It was outperforming any of the other indices. We had support levels at just under 2,500 and again at 2,450, and we've just gone barreling straight through those, and we ended up down under 2,400 on Friday. So I think we'll see a bit more downside, probably another couple of hundred points on the Small Ordinaries Index. But apart from Friday, sentiment had been holding up very well. So I'm not dismissing the Small Ordinaries Index as still a good trading avenue. So that's it for this week's update, general update. I think there are wonderful opportunities coming, both on the short side and the long side. We just need to maintain a fairly low exposure at the moment and wait for those opportunities to present themselves. So that's it for this weekend. Talk again next weekend. Cheers.